Hi, welcome back to the channel. It's Anthony here and we're talking money. I thought in today's summary of what the newspapers were saying over the weekend, in particular the Financial Times, which to be honest is the go-to newspaper for macroeconomic ideas and what's happening in the markets really. There are three articles that I took my attention really. One is in the FT money section of the FT. And this one particular, the back page was written by Merrin Somerset Webb, who's an absolutely fantastic financial journalist. She's talking about the bond turmoil, which triggered the most recent share sell-off that we saw on Thursday and Friday. She's basically talking about the traditional 60-40 split in a portfolio, sort of 60% shares, 40% bonds, and why the most recent movements in bond prices might spell the end of that sort of traditional 60-40 portfolio split. Essentially, the 10-year US Treasury bond yield is probably the most important interest rate to look at because it gives an indication as to what the market is thinking about long-term inflation at. So bonds in general are very sensitive to interest rates, and interest rates are the main focus of, or the main weapon of choice for central banks to combat inflation. And over the last few weeks and months or so, the US long dated, the 10-year US Treasury bond has actually tripled in yield and is now standing at 1.6%, which historically is still quite low, but it's where it's come from and where it's heading to is that matters. So with increasing bond yields, the temptation for investors is to reduce the amount of money that they hold in high risk assets like shares. And so that is one of the reasons why we've seen a bit of a share sell-off recently, is because investors are getting spooked really by the prospect of higher inflation, higher interest rates, which has manifested itself in higher yields in the bond market. Now, the problem for a traditional 60-40 split portfolio is that as bond yields go up, bond prices go down. And so if you've got bond prices going down, then, and also you've got equities also going down because they're spooked as well, bonds no longer give you that protection in a portfolio if they're heading south as well. So a lot of people are saying actually you should decouple the sort of bond equity ratio, 60-40 ratio, because it's not going to do you any favors in the future. And that's the sort of main thrust of what Merrin Somerset Webb is saying in her article there. The main thrust of her argument basically is in her last paragraph here, which says that inflation isn't great for equities, or certainly not great for some equities. It's good for those that are able to set their own prices in the marketplace, but the main thing is that it's absolutely horrific. Inflation is terrible for bonds or any asset class really where you've got a fixed income, and bonds are fixed income. So that is why people are exiting bonds and therefore driving the price down, that's sending the yield up. Her advice anyway is to have a little bit more gold, which is traditionally seen as an inflation hedge, a little bit of cash so that you can benefit from any downturns in the market, and get away from that traditional 60-40 split. 60-40 splits are quite often applied by fund managers, pension companies and people like that. If you're a private investor doing your own thing, then you may have 100% equities and very few bonds, if any at all. So anyway, that's her article. I thought that was a really good one to read there. Right, the next article that I wanted just to touch on is in the main financial part of the Financial Times this weekend, in the big read as it were. It talks about Bond Vigilantes. Now, bonds are in the news at the moment because they have had such a big sell-off on sort of late last week, driving 10-year Treasury bonds to the highest bond yields, I should say, to the highest that they've been for a long time, and that has spooked equity markets as well. And Bond Vigilantes is a term coined by Edward Yardeni, who in the 1980s, who was also a advisor to the Clinton administration. Now, Bond Vigilantes is a term that refers to people entering the bond market basically selling it or shorting it or just getting out of the bonds altogether, driving the bond price down and putting yields up to such an extent that it actually influences government policy. Governments can print more and more money and have a very loose monetary policy, quantitative easing and things like that, and they can do that so long as there's no penalty. One of the main penalties for doing that is inflation and interest rates. And interest rates are so damaging to a weakened economy because it drives up the cost of borrowing. So without those checks and balances in place, you could say that governments can get away with anything. Now with Bond Vigilantes, you can say they actually have a particularly useful role because they give a very sharp reminder to governments that they can't do exactly what they please. And so the return of Bond Vigilantes is a term that actually quite sort of nicely sums up what may have been happening in the bond market recently. That's quite an interesting read as well. And then finally it comes to my third article, again by Michael Mackenzie, who's probably my favourite journalist in the FT, in his article The Long View. This time he's looking at financial stocks being well placed to thrive in the bond rout, and he explains why this might be the case. Essentially, things are looking much brighter in the longer term. Financials are expected to benefit from the consolidation and cost efficiencies, while the industry embraces the benefits from the digital revolution sweeping through finance. That's the one sentence that stands out straight away. But also remember that higher inflation and higher interest rates also means that bank profitability also goes up as well. They can have more of a margin between what they, the interest rate that they lend out at, and compared to the savings rate, interest rate, which they have to pay out to savers. So the higher the interest rate, there's more margin to play with. With interest rates very, very low, you can have 0% on saving rates, but also a pretty low rate on lending rates as well, so the margins are much smaller. Now he says, in particular reference to the US banks, what's the real difference for financials in this recovery is the fact that US banks will ultimately be the big winners of this particular business cycle, and the reason being is that they go into this cycle without carrying that much bad debt from the downturn from the pandemic crisis. So that's a big benefit to the banking industry, that they don't have to shrug off that overhang from an economy that's really collapsed. And the reason why the economies haven't collapsed like they may have done in previous recessions is that in, say, the case of the UK, we've had the furlough scheme and other government schemes to prop up the economy. And in the US, they've had stimulus programs, and the latest one is a $1.9 trillion stimulus program, which is 9% of GDP. It's a huge stimulus program. So that's why a lot of companies aren't carrying the bad debts, or sorry, banks aren't carrying the bad debts that they may have done before in any sort of kind of recession. So he's basically finalizing his article here by, could we see a repeat of what happened in 2013, where the US financials banks rose by 1/3 and shrugged aside a bond market tantrum that saw a doubling of the 10-year interest rate to 3%. Bearing in mind that the 10-year interest rate on US treasuries is now 1.6%, it's got an awful long way to go before it gets to 3%. And that's in a period where banks rose by 1/3. So, that's one sector that might actually benefit from bonds going up, interest rates going up, and the economy coming out of a pretty torrid time of the pandemic. Anyway, those are my three little articles that I took away from the most recent FT over the weekend. This one's dated the 27th, 28th of February. And so that's it. So anyway, I hope you've enjoyed this little video, which is just a newspaper roundup summary. And if you have, then click that subscribe button and the like button. It really helps the channel out. And I'll catch you in the next video. Anyway, I'm Anthony, and as always, we're talking money. Till the next video, bye for now.